The euro area minus 3.8, UK minus 2, Germany minus 2.3, France minus 5.8, China minus 6.8. These are large and shocking numbers. Now, on top of that, Q2 second quarter is likely to be worse. And that is because that is when there are more stringent containment measures in those economies. So in a sense, this confirms the very dire situation that is there in the global economy. Now, at the same time, we welcome the stimulus or stabilization measures that have been put in place by the various authorities around the world. Now, coming closer home, last month we mentioned the newly released GDP data for 2019, and also at that time we also talked about our projection for 2020. And the number for 2019, the economy grew by 5.4%. This is, I'm repeating numbers that we talked about a month ago, 5.4% in 2019, and that was relative to 6.3 in 2018. And at that time, we forecast a growth of 2.3% in 2020 and 6.4% in 2021. Those are the numbers we communicated last month. And at that point, we also underscored that these projections are highly uncertain, unusually uncertain. Now, we have had some new data, but this data are really on leading indicators. We do not yet have the first quarter numbers for 2020, that is for us here in Kenya. We expect that in a few weeks. But I think the point we would want to emphasize is the new data of the leading indicators in Q1 of 2020, things like, for instance, electricity consumption of petrol and diesel, importation of intermediate goods, etc. All this show that Q1 was relatively strong. So there is a bit of a bifurcation between what is happening in the global economy and what is happening in our Kenyan economy, the domestic economy. However, the indicators for April, that is for our economy, are mixed. There are, for instance, the transport on SGR, in terms of volumes, number of people and all that, that obviously has come down dramatically. And as you can imagine, this is obviously as a consequence of the lockdown, partial lockdown, and cessation of movement out of the various counties, Mombasa and indeed Nairobi and other counties. And other numbers such as excess duty, also that has come down, which really means consumption isn't taking place. And you can imagine the various products that attract excess duty. And also tourist arrivals have really declined to nothing in April. Obviously in March they came down dramatically, and complete shutdown really in April. Hotel bookings also have come down to, have really fallen. And on the back of all this, of course, you also have the news about agriculture. Agriculture is chugging along, and that obviously is will be impacted by the rains and the weather conditions, and indeed some of the transportation issues that they may be having from the farms, let's say from the farm gate to the various markets where these things are sold. Indeed, also the containment measures. So in a sense, we have mixed bag, but I think it is important to appreciate that there's a bit of a bifurcation between the advanced economies and ourselves. That said, we have not revised our forecast for 2020. We have kept it the same as it was in April, and we will do this as soon as we have the actual Q1 data, which will be in a few weeks. Another thing that the MPC considered was obviously the economic stimulus program that was announced just last Saturday. It's interesting that the focus of this stimulus program is to cushion the vulnerable citizens and businesses, and also to enhance economic activity. So in a sense, to have a safety net for those vulnerable citizens and their businesses. It has actually targeted the critical sectors, and from the perspective of jobs, so employment, that is key. Wages, that is really the focus. It is also interesting that the economic stimulus package or program has in its sights also the MSMEs, the micro, small and medium-sized enterprises, of which we have said before, this is the backbone of our economy. So in a sense, targeted, and therefore less likely to, or rather more likely to be effective, and targeting the critical sectors. We as MPC looked at this and realized and appreciated, or should we say judged, that it has a high chance of success, and its expeditious implementation will be supportive of the economy. So those are the general points in terms of how the MPC saw the development of the economy, or the current structure, the conjuncture of our economy. In terms of the external sector, the exports for January to April 2020, this improved by about 5% compared to a similar period in 2019. Now, tea grew by 15.8%. That's huge. Both because of higher volumes and favorable prices. The higher volumes, I think those relate to the weather conditions and things like that. Now, horticultural exports, however, fell by 7.5%, but within horticulture, there's a lot of sort of dynamics, different dynamics of the components. So I'll mention some of this and move on. I think the first thing to mention here is about flowers, which is obviously a significant element of horticulture. And the prices improved in March and April. Obviously, volumes were much lower, particularly in April. We all know that there was the, let's say, lack of cargo flights, and those have been put in place. And so that is expected to grow. As a matter of fact, more generally, volumes of horticultural exports in the first half of May was 63% of total volumes in May of 2019. So more than half. So you can see that they are coming back. And obviously all these exports are being by air. Exports during the same period, the first half of May, were in volume terms 90%. 90% of the exports, flower exports in May of 2019. And in value terms, there were 87.5% of the flower exports in May of 2019. You can already see that these numbers show that there is sort of a return to normalcy in particular, let's say, sectors. And I think horticultural exports is one such sector. We should also say that this is on the back of various government policies, or various policies, and indeed negotiation and approval, and indeed implementation of more cargo spaces or more cargo flights. Also the cessation of constraints that were, let's say, constraining exports, particularly flower exports in the main auction in the Netherlands. So you can see those are coming back in place. On remittances, We have numbers for April that was mentioned in the press release, but I think I want to mention it separately. This declined by 9% in April relative to March. But interestingly, remittances from the US, which is our main source, have held steady. And obviously, we expect that the containment measures, lockdown and other measures that have been imposed were imposed in the advanced economies would continue to affect or to constrain the transfers of or remittances back to Kenya by the diaspora, the Kenyans that are abroad. But I think the point here is that as those economies reopen, we would expect that there will be a return to more normalcy as well in those sectors. Just for you to note, for the year 2020, we are projecting a decline in remittances of 12%, about 12%. In US dollar terms. Another point to mention, to flag to you, is that we have been receiving significant official capital inflows. And we have mentioned this in other discussions. For instance, the IMF, emergency support, the RCF, we received the equivalent of 730 million US dollars. The World Bank just recently, a week ago, approved support, DPO support. It's in 2 tranches, 750 million US dollars, and also another 250 million, so totaling 1 billion US dollars that was approved and is disbursing. The 750 has been disbursed, and the 250 we expect it shortly. Also last Thursday, the World Bank approved a credit, IDA credit of 43 million US dollars. This is to support the fight against the locusts. And also last Friday, the African Development Bank approved a loan of the euro 188 million. All this to support the government's efforts related to the pandemic. So you can see we have received a lot of or some official capital inflows, which will be supportive of those specific efforts in terms of budgetary support, and also will be supportive in terms of the foreign exchange market. So we will have ample reserves consequently. But I think another element which we need to flag is that the approvals and indeed the disbursements, they are a vote of, is a positive, is an approval of how the economy, meaning in terms of how the economy has been managed, and indeed in terms of the prospects of the economy. So in that sense, they are putting their money where their mouth is, and in a sense, it is a vote of approval. It's a positive vote on how the economy is being managed, and also how the medium-term and long-term prospects of the economy. Bottom line in the external sector is the current account deficit. We project it to remain around 5.8% of GDP, so no change really in this. And reserves, as we said, will remain adequate given all the various explanations I mentioned. There are some things I didn't want to belabor, like the price of oil and things like that, but I think all that is put together, we get the current account deficit that I mentioned. Moving on, I'll say a few things about the banking sector. And I think this has been, the news from the banking sector, I think, are good news in terms of they have remained operational throughout this period. And not just operational, they've been protecting their staff and clients. And this is important because first, banks signal that the economy is working. The economy continues to work. There is a very strong signaling effect from banks remaining open. And at the same time, they have done this protecting their staff and their clients. And as I said before, we had indicated to them some of the measures they needed to put in place so as to protect their staff and also protect their clients. And even as all this is happening, and the various containment measures are in place, they have operated at all places. As a matter of fact, a good example is when there was this sort of lockdown in Eastleigh here in Nairobi, and also Old Town in Mombasa, banks continue to operate. Particularly here in Eastleigh, there are 9 branches, 9 bank branches, and they have continued to operate even in the context of the lockdown. So I think, obviously, with the enhanced measures and all that. So I think the point we are making here is that that is an important signal of the economy remaining operational. Now, in terms of numbers, it's important. It's good to say, well, I would again say that the banks remain resilient. They remain strong. But the numbers indicate that. It's true, NPLs to gross loans have increased to 13.1%, mainly in real estate, trade, and manufacturing. But these loans actually were already on watch on March 1, 2020. So they were already on watch, and in a sense, they kind of moved, they then got classified correctly, meaning these were not things that were current at the beginning of March. Now, they have obviously been hit by various factors before, and maybe the COVID situation has worsened their situation. Secondly, the loans that were performing on March 2nd, there has been a lot of rescheduling that has taken place over the last 6 weeks. And on personal loans, something like 102.5 billion have been restructured. And this is something like 13.1% of the personal and household loans, the portfolio of personal and household loans. Other sectors, there's something like 170 billion that have been restructured. And totaling in all this, you have 273 billion that have been restructured. And this is about almost 9.5% of the total loan book. The total loan book is about 2.8 trillion Kenya shillings. Now, this is only in the first 6 weeks, and we know there has been an acceleration in the current month of May. But I think the point here is, again, we urge those that have been affected by this pandemic to go and visit their banks, have a conversation with your banker and explain to them, maybe bring your pay slip, and also bring the letter that you had, maybe that sent you home, or laid you off, or those letters that actually indicate your specific situation. You do have, for instance, shops that the number of clients have come down dramatically, like malls, as you know, and they too have had that conversation with their bankers, which has helped them also transmit the benefits to their clients, or should we say their tenants. So it is important, again, to underscore the need to deal with this in a systematic and I would say organized fashion. So those are the important points in terms of the decisions that the MPC made. So as was indicated in the press release, it was clear that the measures that were put in place at the beginning, including obviously the reduction in CRR and all the other measures, was still working, and the reduction in the CBR was still working themselves through the system. And there was going to be the economic stimulus program that is going to be put in place shortly. So on balance, they assessed that the stance of monetary policy was the correct one, and we needed to see those other measures and see what is it that their impact, how is it that they're going to support the economy, and then advise accordingly, or let's say take actions accordingly. In the interim, of course, we will maintain our stance in terms of watchful gaze on the economy, monitoring developments in all areas. That's all I wanted to say in terms of the specifics, but now I have a few items which may be of interest to you, so I'll just go through them and we'll see whether these are of interest to you. I want to go back to a point I mentioned earlier about the SMEs. And this was one of the points of focus of the economic stimulus program, and wanted to underscore the urgency of dealing with that, and in fact the urgency of putting in place the credit guarantee schemes. And the urgency is clear to us. We are close to some of this sector, some of the operators in this sector, so we understand it. We, in a sense, have a pulse on that part of the economy. And suffices to say that SMEs, MSMEs as well, don't have a lot of, let's say, buffers in terms of credit or in terms of other resources that they can use. And therefore, they generally would die quickly. So they are very vulnerable in that sense. And as a matter of fact, there was a survey that was done at the end of April, and that survey indicated that three quarters of SMEs, of the surveyed SMEs, do not have cash beyond 2 months. So that means by end June, these three quarters of SMEs would be, they're on the ropes. They'll be gone because they don't have any cash to keep the lights on, to pay for even, all the things, supplies, if they have to get supplies, or even to pay for their own workers themselves. So that is how critical the SME issue is. Now, it's not just financing. The SME situation is not just an issue of throwing money at SMEs. It's also an issue, it is finance plus. It's an issue of also providing them with appropriate solutions for their problems. For instance, products, demand for products. Now, it's true, we know some of the SMEs have switched to making the PPEs, the personal protection equipment, the masks and other things like this. But it is important for whatever action is taken place, whatever policy action that is taken place, that will be put in place, to be focused not just on finance, but also on the other side of it, which is the plus side, which is the products and things like that, so that the SMEs can actually produce for particular markets. It's that sort of connection that we want to underscore. So that's the reason for the urgency of the credit guarantee schemes. Because if we don't have one quickly, as I say, the matter is dire, and it will only get worse. There won't be a solution, and it will get worse. That's one point I wanted to make. On other points, there are some concerns by some of you, I think, about so-called IFRS 9, and how does this relate to what the policies that we, or let's say the measures that we recommended to banks and banks are undertaking in terms of restructuring loans and things like that. I think that is a much more technical issue, and I think it is fine to raise it in technical in a technical way. But I want to make a few points on this. It is true we have looked at this thing, and it is important to understand that yes, we do not want, what we cannot do is to allow this to become sort of a critical issue that that indicates that there will be significant increase in credit risk of specific borrowers and things like that. So we have, soon after we made our announcement, the BIS actually sometime in mid-April did issue its guidance as well, which is completely consistent with ours. And indeed, we are talking to ISPAC. These are the ones that are close to the auditors, so that there is a guidance note on the application of a uniform approach. It is true some of you have been concerned that there may be a haphazard, non-uniform approach, and therefore this is why it is important to work with those particular institutions that are charged with that responsibility, but explaining to them how is it that this would or could or should take place. From our perspective, these are exceptional times. This is highly exceptional and unusual circumstances that we face. And in the circumstances, and it is not the individual borrower's credit risk that has changed. As a matter of fact, providing that temporary relief would, during that, let's say, gap period, when the economy reopens, the borrower continues, I mean, if everything is as before, then credit risk wouldn't have been changed, wouldn't have in any way been altered. The point, of course, is that the banks need to assess that well, so that it's clear that they are not penalizing themselves, nor are they penalizing the borrower. So I want to leave it there. I want to make it clear that it is not a mechanical sort of issue. It cannot be done mechanically, as most of you understand. But I think the point here is not to worry about it, because we are working with the various entities and following the general, let's say, approach that other institutions, meaning regulators such as ourselves, are doing in their own jurisdictions. There was a final point, well, maybe 2 points really. There was a final point about innovation, and I think this was raised by Professor Ndemo in an op-ed in today's one of the papers today, and I think I would differ with Professor Ndemo on this one. His concern is about innovation, and he was talking about innovation and CRBs, the credit reference bureaus, that the recently implemented regulations may be stifling innovations. The other points he made. Also in terms of the banks' roles, with the role of the banks with the fintechs and things like that. So I'll just make a couple of points on this. This is a question that is as old as time. The balance between innovation, more generally speaking, and regulation. In a sense, we all know that innovation cannot be allowed to run amok in the economy, or anywhere for that matter. Unfettered excesses of market, let's say capitalism, will obviously be will also be detrimental to particular ways. So I think that is clear. Policy is always about that balance, balancing the need and, should we say, the benefits of innovation, and constraining so that you don't have those negative externalities that could come. For instance, we made this point very clearly about the issue of consumers. Consumers need to be protected, and the consumer, should we say, the way the consumer is dealt with is important to us as a society, as a people, and innovation does not get a free license to do that. I think that is clear. But I think also, so that is something we'll continue to work on. We are not going to change that, and we are not the only institution in the world that actually makes it very clear. And we have been in this journey for several years, and it has worked quite well. Secondly, the role of banks. Here, I think, with fintechs, here I think there's an issue as well. Banks are no longer at odds with fintechs. As a matter of fact, over the last couple of years, the banks have been working hand in hand with fintechs. They've been working hand in hand with fintechs, particularly in dealing with those solutions. So I think the point there of thinking that the banks are sort of at war with the fintechs and stopping them is really, does not agree with the facts as they are. As a matter of fact, as we know recently, and we've been looking at some of the fintechs closely in the context of our work. For instance, in the context of the African-Asian Fintech Festival, we had a whole bunch of fintechs that have been working with us, and we have continued to monitor them during this period of time. And a lot of them have succeeded quite well, even despite the pandemic. There are actually 3 that are quite significant in terms of they did well in our ranking in the hackathon that we had. And these are, for instance, there's one of them known as Quara, which is doing work with SACCOs, very interesting work. Actually, they're expanding, not contracting. There's another one known as Lami, which is also doing insurance in particular ways, digital platforms. Also, they are working hand in hand with other institutions, including banks, and they're expanding, not contracting. So I think the facts are clear, and innovation does not in any way, should not be left on its own. There has to be that balance, which we believe as regulators we are at the right place to make that balance. The last point I wanted to make is on Moody's. You do recall a few weeks ago, Moody's did issue a statement about Kenya, and in effect what they did is they revised the rating outlook from balanced to negative, and or stable to negative. But they did not revise the rating itself. They confirmed the rating as it was then. And I think it is important because they did indicate why is it that they had come up with that outcome. And I think from our perspective, yes, we did see that their concern was that there was an increase in let's say demands on the budget, on the fiscal authority, and indeed an increase in debt levels. And in a sense, it was also appreciated that was because of the conjuncture that we had, meaning the pandemic, in the context of the pandemic. By the way, virtually every single country has ended up having, let's say, an increase in budget deficit in this time, because the balance, again, we go back to this issue of balance. Life is about balancing things. So the balance, again, between maintaining a sort of a path, a consolidation path, or working to deal, meaning provide resources to deal with the health crisis, so that it may not become an economic and financial crisis. That balance obviously has to be struck, and I think that they acknowledged that, and that's why the outlook was revised to negative, and they maintained the rate. So I want to stop there. I'm sure you have many other questions, so I'll let you answer the question. I'll listen to the questions and answer them. Thank you very much.
So that was the Governor, Dr. Patrick Njoroge, giving background to the MPC meeting and statement that was issued yesterday. There's quite a number of questions, as you would expect, and we shall go straight into them, as we will do today, like we usually do, is take them in batches. So if you're asking any questions, please make sure you go to the place that we had recommended for you, which is Slido. The meeting is MPC 28. So to begin, we will begin, Governor, with Razia Khan, who is the Chief Economist for Africa for Standard Chartered Bank. And Razia asks, given that these are not normal times with a severe global downturn, does the MPC think of a range of real interest rate outcomes that would be acceptable? Given that these are not normal times with a severe global downturn, does the MPC think of a range of real interest rate outcomes that would be acceptable? That is from Razia Khan from Standard Chartered Bank. The next one is from Gerald Gekara from Uzalendo News. Are the newly reviewed economic policies on taxes responsible for the declining value of the Kenyan shilling? I shall try and speak up. We are socially distant, as you expect. So I'll just repeat that from Gerald of Uzalendo News. Are the newly reviewed economic policies on taxes responsible for the declining value of the Kenyan shilling? The last one in this batch is from Kefa Moirore from Radio Citizen. The CBK retains an ambitious GDP projection for 2020 at 2.3%, as other entities see negative growth. Why is this the case?
Can I take those, please? Yes. Okay. Maybe I take the first one, Razia Khan's question first. Hello, Razia. Your question about the range of real interest rate outcomes. I think what I would say here is that we are not exactly looking at the sort of, let's say, targeting any of these real interest rates. You can say that there are some things that we are comfortable with, but those I think are standard. Obviously, we want to have positive interest rates, but I think, but I think the issue here is precisely as you said at the beginning. This is a temporary deviation from where we would want to be. So even as maybe your question suggests that we could be more aggressive in terms of lowering the interest rates, and therefore end up going to maybe closer to zero, or should we say negative real interest rate sort of range. I think the point here is to appreciate that interest rates is just one of several policies. And as we explained earlier, we are waiting for that other side to sort of pick up. So I think for me, the point to mention here is, in general terms, we want to maintain positive rates. That I think is a long-standing sort of position that we've always had. I think any economist would have that position. But also to appreciate that interest rate policy is just one of several tools in our toolkit. And at this moment, we are working with the other tools much more. I mean, never before, it's been a long time since we altered or changed the CRR, for instance. And this has been beneficial. We did talk about how much maybe it was 85% of that had already been released to the banks. And so there's still some other, I think it's 23, well, I don't remember the precise Kenya shilling equivalent that still needs to be absorbed by the banking sector. And there are the other elements, which is the fiscal policy side. But I think, Razia, I would also emphasize the following. We are in unprecedented times, as you said. And therefore, the issues before us are no longer just demand management, demand economy, managing the demand of the economy, sort of supply and demand. The issue now is much more structural. And I think this is where we as economists need to understand that there's a significant role for those structural policies. We talk now about the exports of horticultures. And importantly there, the most critical policy there was to actually have cargo space, a very simple thing. But if we didn't have that, we can do whatever we want on demand side management, and it wouldn't have the same, it wouldn't have any effect at all. So I want to emphasize that actually today and now, we as economists should be looking at those other, let's say, disruptions that have taken place and see how to mend them. More generally, we know there has been disruptions in the supply chain. And it is more important, much more important to mend those supply chain disruptions, and then everything will begin to come up again. We had our discussion, and I can finish with this, during the MPC meeting about the output gap. What is the meaning of an output gap that is actually estimated? And I think you can imagine where we ended up, because the output gap, in a sense, becomes less meaningful in context such as this. And in a sense, in the end, it may be large, but that's not what you should be looking at. So anyway, I hope I've answered your question, Razia. The question about the revised taxes and whether this is what is leading to, what is the connection?
Well, it's leading to the declining value of the Kenyan shilling.
So the answer is absolutely not. I don't know whether the issue of, the revised taxes, sure. This was meant to provide more income to, or more disposable income to the population. And I think it was meant to be at the lowest level. So this is why even the people that were paying the least in terms of taxes were given even more, let's say, got less. Well, they pay less in taxes. Will be paying less in taxes. I don't know. That is not, the connection is a bit difficult for me to understand. I have to be honest. All I can say, and this is something I continue saying, and I will repeat it again, the exchange rate policy is very clear. We follow a flexible exchange rate regime, and so the exchange rate can go wherever it wants in terms of supply and demand that are there in the market at this moment. And I think that is what is happening. The only thing we intervene to minimize is volatility. I explained this last time. I explained it in particular to David Helbring, and will also explain it to whoever else wants to know today. But I think the point here is the connection is not the right one. And in terms of the general, what will happen in the FX market, I mentioned in my presentation that we expect this to be relatively balanced. And that's why the current account is coming out pretty much where it should have been, where it was at 5.8% of GDP. And the flows are balanced. Now, it doesn't mean that it will be balanced on a day-to-day basis, obviously. But I think the point is also there is ample reserves, so there's no, there shouldn't be any concern in terms of where the exchange rate will go. And then the question about a very ambitious growth. I don't know. It's not Kefa. Who was it?
It was Kefa.
Yeah, Kefa. I remember you. Kefa, I don't know if this is, I don't know what you mean by ambitious. This is not a target. This is what we, given all the indicators in the economy, this is where we think, this is our best estimate in a very, at a time when there's a lot of uncertainty, So if we wanted to target things, that would be sort of in a context of a plan, right? In the way you'd say this is a 3-year plan, or this, we want to achieve a particular target, and these are the policies that will lead us to that target. So I don't think the issue is ambitious. As a matter of fact, the issue for us is, yeah, I do understand that one could make the case that, the advanced economies are going down, in terms of their GDP growth rates are large and negative. So how come Kenya and a few other countries like this, our neighbors and all that, are still in the positive rate? I would actually twist it around and sort of say, well, maybe Kefa, this is an indication of the resilience of the Kenyan economy. And this is really the point. Why is it so resilient? That's your question. And then I would answer it and say, it is resilient for the reasons that we've mentioned before. First and foremost, we are highly diversified. We are not dependent on oil. Look at the economies that are highly dependent on oil. We are not dependent on primary products. We are highly diversified. We are also highly diversified in terms of our exports, right? Now, it's true we do have some large exports, tea, flowers and other things like that, but we do have highly diversified exports and also destinations. We also are very connected regionally. So we are not just looking at the overseas markets, but actually looking regionally. All these things, there are other things as well, private sector driven. Also, we have good infrastructure. All these things, that is the source of our resilience. I think we should be grateful for those that help build the resilience that we have. And that means yourselves as well. So I think it is more that than asking why the 2.3 is so ambitious. Yes, please.
There's a set of questions, and there are two sets of questions that are combined. So the first one about the foreign exchange, asked by Victor Madala, and an additional question by Kefa Moirori. I believe those have been answered. There are questions combined about the credit guarantee scheme from George Obulutsa of Reuters. This is also from Indeje, from Paul Wafula as well. And the questions combined are to do with the time frame for the implementation of the credit guarantee scheme. And the second part of that question is to do with the amounts of the credit guarantee scheme. Those questions are from George Obulutsa, from David Indeje from Husoko, and also from Paul Wafula. There's also questions from Antoinetta Rusi of the Financial Times. And again, I'll combine two questions. Why is it important now more than ever during the pandemic to set up a framework for the unregulated loan applications? Can you describe what this framework will look like? And then the second part of that question from Antoinetta Rossi of the Financial Times: do Silicon Valley-based loan apps have a future in Kenya post-COVID-19? And do you think they do what they say, which is including low-income citizens in the loan economy? So we'll take those ones and continue with the rest.
Okay, thank you. So as you said, we've dealt with the questions about the FX market and so forth. The question about credit guarantees, you're asking for credit guarantee scheme. You're asking for details in terms of time frames, amounts, design, and all that. And all I would ask you is to be a bit more patient, because that is now in the works. That's really the beauty of it. That's the devil is in the details, as it were. And that is being dealt with or cooked, or whatever the expression you'd want. So I cannot give you any indication on any of those things. Obviously, the lead role is taken by our National Treasury, and it was announced last weekend. So we have barely had a week. It will probably be a significant element in the budget. But I think the only point I would want to stress again, and your question gives me this chance to stress, is the urgency of it. This is extremely urgent. We cannot do this as business as usual. And I think, unfortunately, even when things are urgent, they end up taking sort of the scenic route in terms of implementation and things like that. And from our perspective, this is the one thing we're insisting on. The time frame has to be as short as possible. I already gave you some numbers, George and others, about why SMEs need to be we need to work with SMEs in a very sort of short time frame. I talked about end June. So that's the only point I would make, and also underscore that the details are being worked out at this moment. Suffices to also say that other institutions, IFIs, the international financial institutions, have been involved in this, or will be involved in this going forward, and also the various banking institutions through obviously the auspices of the Kenya Bankers Association, but the banks themselves need to be involved in this. Then there was a question by, well, I guess Reuters on why is it important to deal with the unregulated institutions? Is the credit-only institutions that I presume you're talking about?